Welcome everybody to this short video, and I'm delighted to be speaking to Neil Pandey today, who authored section B of the book on forecasting. Neil, how are you doing?
Very well, Ken. How are you today?
Yeah, good. Thanks for taking the time out to chat. And I guess I'm going to start off, given that the people reading this book are generally those not very familiar with valuation. What's the role of forecasting? Why is it important? And what are you actually forecasting?
Well, valuation is fundamentally based on the future, Ken. So forecasting is absolutely fundamental to that whole process of valuation. So I think in the earlier section of the book, you were dealing with some of the accounting metrics. And to start with, those are the items that we're going to start forecasting. So we can start with income statements. We can forecast various profit measures that you covered. So earnings, net income, NOPAT, EBIT, EBITDA, whichever one you choose. And we can build those into sort of multiples and form relative valuation. We can arrive at an equity value, we can arrive at an enterprise value, but it's going to be based on what we think is going to happen in the future. That is what value is based on. So, to be honest, we can't really do valuation without forecasting. They are inextricably linked.
Fantastic. And obviously, we end up forecasting accounting numbers and statements, as you mentioned there now, Neil. And I'm going to ask you a really tricky question. Which ones are the most difficult, and maybe also which ones are the most important? And I can help out as well on that one.
I'm not sure I've got one that I think is sort of particularly difficult. I mean, I kind of go back to the old quote. I don't know whether it's sort of the great quantum physicist Niels Bohr or the great baseball coach Yogi Berra. But forecasting is difficult, especially about the future. None of us have a crystal ball, and so I don't think it's any one particular element of forecasting that's difficult. I think it's forecasting in general that is difficult. The further we want to forecast into the future, the harder it gets. If we're looking at young, growing companies rather than sort of more mature, stable companies, it's harder. So I don't know about you, but I don't really have one element of forecasting that I think is difficult. I think it's all difficult. We don't know what's going to happen. We're trying to guess and estimate what's happening in the future. And that's really why things like sort of scenarios and sensitivity analysis are so important, which we come to in later parts of the book, which we cover in the free cash flow chapters. We don't know what's going to happen. So we're not saying this is what's going to happen, this is the value of this business. What we're really saying is, well, this could happen, in which case, this is probably the value of the business. It could be better, so the value could be higher. It could be worse, the value could be lower. So we can play out those scenarios and we can then sort of run sensitivities as well. But that's covered in more detail later in the book.
Fantastic. And I think that's really important. Almost nothing that's worthwhile forecasting is straightforward. You want to do a good job. Scenario analysis can certainly help. And what I often tell students when they're talking to me is that if an item, let's say an obscure item in the accounts, is really difficult to forecast, it's probably because they don't understand it, and or it's not really going to change the nature of the valuation that you will end up doing. It's the big things like revenues and costs that are really going to drive it, as the case may be.
No, absolutely. I mean, again, you might find in a particular valuation of a particular business that there is a sort of very specific item that's very unique to that business that you have to nail down. But that's really the exception rather than the rule.
Yeah.
You're absolutely
Yeah.
right. Most of the time, it's the key elements that we have to focus on: the revenues, the costs, the investment, capex, etc. It's those big items that matter, and not some tiny little obscure item.
Yeah. So we now know, or at least our readers know, that forecasting is core to valuation because valuation is about future cash flows and earnings, etc. We know that this section of the book gives a lot of advice about how to forecast items. We've also provided a small forecasting model on the website. So if you were a someone attacking valuation and in particular forecasting for the first time, how would you use these various resources? How should they think of how good they need to be to get at forecasting to understand valuation?
Yeah, so we've got the sort of mini sort of forecasting model that we've included on the website. and that follows along with the chapters 5, 6, and 7 of the book. So I think if you're newer to this, I would actually just start with the book and the spreadsheet and just focus on the basic mechanics that are in there. That's really what I had in mind when I was writing those chapters. So I think the key point really in all of those chapters and all of the parts of those chapters is the key point that what we're using are just individual tools. So basically analytical tools in the first instance, we use to analyze the historical data that we have. And once we've done that, we then just flip those around, we rearrange those equations, and we use those same ideas to drive our forecasts forward. So for example, as you said, revenue is often where we start our forecasting process. And to understand revenue, we tend to think in terms of revenue growth. So we can look at historical sales data and we can analyze what the year-on-year growth rates have been. So that's one version of the formula. Once we've got an understanding of that, we can turn that formula around and use it to try and project forward what we think the sales will be in the future based on assumptions about those sales growth rates. So it's that idea of just taking a sort of fairly standard historical analytical tool and then just flipping it around using exactly the same idea to then drive our forecast forward. So as a starting point, I think if you can understand that that mechanical idea that's sort of embedded clearly into those chapters, I think that's a pretty good starting point.
Yeah, fantastic. In terms then on forecasting, if we then turn our attention to the real world of valuation, that's analysts, etc., out there forecasting and valuing companies. If somebody reading this book said, "Oh, I've got my head around those mechanics," which you very clearly explained there now, I now want to take it to the next level of forecasting. What might that look like, Neil? Well, you know, if they were looking at some more advanced textbooks or more advanced models.
Yeah, well, I think if someone's that way inclined, I think what I'd perhaps do as a starting point is take that sort of mini model that we've got there and have a play with it. Get your hands dirty. That's really the best way to, I think, get used to forecasting and valuation is to do a little bit of it. So you can see very clearly in our little model, all of the inputs are in blue font. That's fairly sort of traditional modeling approach. So you could pick your own company. I'd start with something relatively simple if you're newer to this. I'd also start with a company that you're interested in because it'll make it easier and more enjoyable. But you could just play around with elements. You don't necessarily have to do the whole thing, but you could pick out some of the elements. Like we've said, you could pick out something like revenue figures and think about sales growth, and you can plug in your own numbers. So overwrite the cells that are in blue font, put in some historical data, make an assumption about what you think is going to happen in the future, and build your own revenue forecast. It's quite easy to do with the spreadsheet that we've given people. So that would be one thing to do. Just play around with it, get your hands dirty, and just get a feel for that whole process of digging out some historical data, analyzing it, coming up with an assumption, and driving a forecast forward. There would be no harm in that. But I think what you're really getting at is that kind of implicit in the three chapters we've written, because we're forecasting items to do with the income statement and the cash flow statement and the balance sheet. Although we don't cover it explicitly in the book, it's probably a little bit beyond the scope of this introductory book. But really implicit there is the idea of three-statement modeling. So in an ideal world, and at a higher level, in the real world, what we might do is build a full integrated three-statement model where we forecast all the key line items for the income statement and the cash flow statement and the balance sheet, potentially for several years into the future. And that is a much bigger undertaking. It's a much more complex task. Making sure that it all fits together properly and it all balances correctly is a much bigger job. But in the real world, it's very worthwhile because that then gives me a much bigger picture and understanding of the business. It gives me much more context. And that usually gives me a much better platform to then proceed to do a valuation. So in an ideal world, in the real world evaluation, I would build that full integrated three-statement model, and then I'd build my multiples and cash flow based valuations off the back of that, so that I've got that sort of bigger picture and that fuller context to work with.
Fantastic, Neil. That's really, really clear. And actually, just to add a few things to that, if people did want to know, take the knowledge further and did want to know where to go, we've got a whole set of links to other websites and whatever on our website to help you with that. And secondly, always remember that here we're talking about the mechanics of forecasting. For example, Neil, you referred to there now estimating the historic growth in revenues and then using that as the basis for your forecasting, flipping it into the future, as you mentioned. Clearly, the people who do a lot of that forecasting are known as sell-side analysts, and they do a huge amount of work to come up with what that expected growth in revenues or whatever items actually are. So we're dealing with the mechanics here, but remember, there's a whole other world of forecasting well outside the scope of our book, but which is very interesting and exciting as well. We've got some links to those type of areas of knowledge in the on the website. Apart from
Absolutely.
that, please,
sorry.
Neil. No, you go
I was
ahead.
going to say, in terms of what we're saying, the mechanics, we have focused on the mechanics. It's very easy for me to say, flip the formula around, make an assumption about what you think the sales growth will be in the future, and then arithmetically project what you think your revenue forecast will be. So on one level, that's very easy to do, but as you allude to, in reality, it's much more difficult. How do you come up with that assumption about what the sales growth will be? And again, I've discussed some of that in that section of chapter 5 in terms of understanding the strategy of the business, etc. But coming up with those assumptions is important and not necessarily easy. One other thing you can do as well, again, if you're interested in this whole area, is to read around the subject a little bit more. As it happens, there aren't really a lot of books on forecasting, but there are one or two. So, for example, you could read Super Forecasting by Philip Tetlock. It's not purely about financial forecasting, it's about forecasting in general. But there is a little bit in there on financial forecasting, and it is a very good general work on the whole subject of forecasting and how complicated it is. That would be a nice one to kind of read as a sort of general background work on the concept of forecasting.
Fantastic. What a great recommendation, Neil. Thank you very much for your time. That's the end of this video, and thanks again.
Thanks, Ken.